What most people want is the bottom line, which is the gold piece. This DSP is interesting. The gold price predictions. So I have this prepared for me by our staffers, and I will just open up and read the bottom line. $2,218 in gold, $26.71 in silver. That's our price call. Thank you, everybody. We'll take questions later. Just kidding. We have a model that assesses where the metals would be trading today if it weren't for the leverage speculators. Given that they use leverage, they can push the price a fair bit away from where it should be. Sometimes they're pessimistic and sometimes they're optimistic. First thing that needs to be said about models, all models are wrong, some models are useful. I think that was the guy named Box who said that, but it could have been Feynman. So we have a model that calculates where the metals should be trading. And right now, obviously, if you know where the prices of the metals are today, the prices should be a bit higher. That is that they're unloaded by speculators. Speculators have a downward effect on the price at the moment, but that could reverse in a hurry. And that's the current snapshot. There's nothing more than a snapshot. So the bigger question is, what's the longer term trend? Are we in a new bull market for metals? There's been an awful lot of head fakes since the last real bull market in gold and silver, which was either arguably 2001 through 2011, or if you look at 2008 as a break in the bull market, end of 2008 through 2011. Are we in that phase again? And I think the answer is yes. I mean, whether it gets as manic as that did remains to be seen. But I think there's a bull market going on right now, and likely to continue. And the reason is simple. It's falling credit quality. Mainstream thought tends to focus on quantity. I'm working on an academic paper right now in my copious spare time. Talking about and finding the right citations. Friedman freely would migrate between gold production by miners and a gold standard, gold denominated credit in an honest monetary system where credit is only incurred by borrowers who have the means and intent to repay, and irredeemable credit, which is what we have now, which is fundamentally dishonest credit. And that Friedman made no distinction between those three different things. Now, you would think that since they have radically different causes, I mean, what motivates a gold miner to produce gold is not the same thing as what motivates the Fed to increase the money supply today. So given that the causes are different, you'd expect the effects should be different. But mainstream thought doesn't really think that way. And so I'm trying to introduce to the world an idea of thinking about the quality of the money and not just the quantity. And it's the unfortunate reality that probably for the past 100 years-ish, since the Fed has been created and arguably before then, at every major turn, they cheat. I mean, that's what they do, is they find some new trick, some new way of cheating, some new nomenclature to conceal what they're doing, literally change the rules. Right? If the Fed is losing money, which it now is, they have some special Fed rules for accounting that only apply. You couldn't do it if you try to do what they do. You go to prison. If it was a public company, you're writing your books that way. But they just write whatever rules they want, and they keep cheating. And the question here is, what is the net sum, the net effect of all this cheating? And the net effect is a decline in the quality of the thing that they emit as their credit paper, which we call the dollar, which we call money. It's a declining quality. So people are turning away from this as it gets worse and worse. That's why the price is going up. It's not a function of the quantity. If you plot the gold price against the quantity of dollars over long periods of time, you don't really see a good correlation. It just isn't. In past gold outlook reports, we plotted gold against everything that drives and causes the gold price to go up. And it correlates badly with all of them. Doesn't work that way. But there's a decline in credit quality. The elephant in the room right now surely is Silicon Valley Bank. Before Silicon Valley Bank, for me to talk about opaque, unknowable risks was a bit of an abstract stretch for people to understand it. But now with Silicon Valley Bank, I think it's abundantly clear that your bank could go bye-bye, and with it potentially your deposit. And that's what Silicon Valley Bank depositors thought. The ones who had more than the FDIC limit of 250,000 on that Friday, they thought, okay, they're screwed. The FDIC said for everybody under 250,000, your funds will be available Monday morning. That's great. For everybody over 250,000, you're getting whatever it was, 40, 50 cents on the dollar. You'll find out the rest when we liquidate all the assets. But by Sunday, they announced that depositors were going to be whole, even the big ones. They're just changing the rules as they go. There's no rule of law. That went out the window and under the bus. So how do you assess the risks of owning dollars, which means owning bank accounts? Unless you're really, really big, that means bank accounts. How do you assess that? It's unknowable. It's imponderable. And so people are saying, okay, well, if the currency is untrustworthy, I'll turn to gold. That's what they've always done for thousands of years. And that's what's happening now. The two, and I thought I would kind of center my talk here around the two giant stories that are going around. You can't read anything about gold, finance, alternative economics, alternative assets, or even mainstream without seeing these two stories. And one is that the world is rejecting or repudiating the dollar. The dollar is losing its reserve currency status. And the other is that China or Russia or the so-called BRICS, Brazil, Russia, India, China, are introducing or about to introduce or have introduced, some people believe, some sort of new gold-backed currency that is going to take away all the demand for the dollar. I just want to say before I get into this, that the risk, if you try to debunk these ideas, say this isn't true, this bad thing about the dollar isn't true, then most people, because this is how politics work in this country today, assume therefore you must be a proponent of the dollar. You must be a paid shill for the Fed. Otherwise, why would you say this? If anybody pro-gold would look for any argument that was against the dollar of whatever nature. And I say, wait a minute. If I believe in something, I'm doubly concerned about bad arguments made in favor of something that I favor. Because the bad arguments can be debunked, and then that leaves people thinking that the good thing is supported by the bad argument. And so I'm not saying that the dollar is good. I'm saying it is what it is. And what it isn't is being repudiated. If I use the analogy, 100 and something years ago, there were coal mining towns like in West Virginia, and the company kind of owned the town to the point where they would issue their own scrip. People who worked in those towns and in those coal mines were not paid in dollars, they were paid in company scrip. And which is a really bad deal for the workers. Tons and tons have been written about this. Imagine if somebody who lived in one of those towns somehow thought that the scrip was going to replace the US dollar. That would be a gigantic error of misplaced proportions. It's the person who would rather drive from here to New York because they're worried about the risk of the airplane crashing, not understanding that the risk of crashing in the car is like 3 or 4 orders of magnitude greater than the risk of the airplane crashing. The other currencies of the world would be analogous to company coal mining town scrip. I mean, it's that disproportionate. And to say that somehow that one or more of those scripts is going to take over the dollar is just preposterous. That's the first thing that needs to be said. The second is that people don't understand the nature of the dollar when they think, okay, all those dollars are going to come back to America. That's the fear. Quantity-based thinking, all those dollars are out there, so that's why we don't have inflation over here. If the dollars were to somehow come back, it would cause inflation over here. The so-called Cantillon effect, which might have made sense in medieval Europe when you think about how gold would be propagated, by merchants slowly, bit by bit. So if there was a big flood of gold at the border, bit by bit, it would be carried, but it would take months or years to propagate across the economies of Europe and do whatever it did to prices. Today, credit is more or less instantaneous. It's not true that they create credit and only the crony corporations have access to it. And when they spend it, when they trickle it down, everyone else gets access to credit. If you're looking to borrow money on a small business loan or mortgage or any other kind of loan, everything is repriced daily. There isn't this propagation that takes a long time. But there's something else that's more fundamental than that. People think of the dollar as an entity, like an object, like a gold coin. And if I have a gold coin, which I don't, but I have a little plastic USB dongle, and I hand the gold coin to John. No, it's not yours. I'm not giving away my gold. Sorry. Keep my gold. If I hand away my gold coin, then the gold can travel in this sense. And I think of the dollar as the same thing, but it's not so. The dollar is not a thing. It's not an object. It's not an entity. It's not an existent. It is a relationship. Gold coin is not a relationship. If you own a gold coin, a piece of metal, that's it. But a dollar is a relationship. It's a relationship of credit, of being owed. There's an ower and an OE, and you're the OE if you hold that dollar. It doesn't travel in that same way because it's attached to the ower. And so what Europe has done, what the rest of the world has done in what's called the Eurodollar system, those banks are issuing and creating, and there's a lot of confusion around this because people call it money. And so it's not money, it's credit. They're creating credit, and they say out of thin air, but they're expanding their balance sheet. That's how banks work. They're creating credit all around the world. And in the process, there's an ower and an OE. Those relationships are local to those economies because that's where the economic purpose was in the first place. And so the dollar it dominates not only trade, it dominates world reserve balances. The dollar is the largest reserve. I saw a graph over the weekend, or this morning, I guess I should say, showing the percentage of assets that are, reserve assets that are dollars versus everything else. The next closest currency is the euro, and it's this tiny fraction of what the dollar is. But when you realize that the other currencies are dollar derivatives, this is the next thing to realize. The euro is what? It's backed by dollars. When you realize they're dollar derivatives, if one dollar derivative is substituting for another dollar derivative, or even the dollar itself, that is not replacing the dollar. That's just shuffling the chairs on the deck of the Titanic. Really nothing more than that. So this idea that somehow the dollars are all going to come back, somehow they're going to be repudiated, is just absolutely preposterous. I won't even get into the arguments why the dollar is better. It's the least dirty shirt. It's the basis of the whole thing. So we interviewed on our podcast, I guess last month, I lost track of time, a guy named Jeff Snyder, who talks about the Eurodollar system and teaches a course in it, or courses. And we're talking about what percentage, so there's something like $2 quadrillion of derivatives out there. The derivatives are options, swaps, swaptions, which are options on swaps, and so on out there, the lion's share of which are either currency or interest rate related. What percentage of all the derivatives out there do you think have the dollar on at least one side of them? Anybody in the room care to hazard a guess on this? And no cheating if you saw that episode of the Gold Exchange podcast. 96%. So he basically said it's not like there's the dollar and the other currencies. There's the dollar and that's it. And all the other currencies are just he didn't use the term dollar derivatives, but I would. It's a dollar world. If you and even in good places, and we weren't even talking about Argentina, places like Switzerland, I took a taxi and discovered as I was done in getting out of the taxi, he didn't accept credit cards. And I don't generally carry cash. So I asked the taxi driver if he'd be happy to accept US dollars, and I had dollar bills. Absolutely. He took them at par, even though the franc was $1.06 or something like that. He was willing to be shorted just to get the dollars. You would not find a taxi in Phoenix that would take Swiss franc, paper notes. He would look at it and say, this is kind of, I don't know what this is. The other rumor that's running around the world right now is this idea of they're going to create a gold-backed currency. So I would say to people, okay, raise your hand if you're going to send your gold to President Xi in China or President Putin in Russia. Nobody ever raises their hand. This is one of those things like how people vote for mass transit or light rail. They always think everyone else is going to do it, and I can benefit from them being not in my way, blocking the creating traffic in front of me. Everyone thinks that everyone else is going to do this, and that's what's going to drive the dollar down, and therefore drive gold up, and therefore they're going to benefit because their gold position is going to go up. When you talk about a gold currency, there's really three basic visions that people have for this, and two of them don't work. The first is, well, we've printed X number of units of our currency, and we have Y number of units of gold sitting in a vault somewhere. Trust us, it's all good. Because our currency is, we say it's back 20 to 1 by, or whatever percentage by gold. Trust us, the gold's in the vault. Wink, wink, nudge, nudge. Everybody see that fake wink? Nobody, that kind of trust, I'm not sure it ever existed in the world, but it certainly does not exist today. That's nonsense. Number two, the one that I think most people that are more serious about gold standard, gold-backed currency, think in terms of a price fixing scheme. At the Fed or whatever central bank, they believed that about a year ago that Putin's central bank did this in Russia, that it's declaring a price fixing scheme that the dollar is going to be, or the gold is going to be $2,000 an ounce. And if the price of gold goes down, we're just going to print more dollars and make the price go up. And if the price of gold goes up, we're going to unprint dollars. It's not even clear what the mechanism would be. If the price of gold was too high, we're just going to have a price fixing scheme. And that doesn't work. Every single instance in history of price fixing schemes always fails, because in the end, the price is wrong. And if the price is wrong too low, you get one accelerating wave that you can overrun. And if the price is wrong in the other direction, you get a different kind of wave that accelerates and overruns you. So none of those work. What a gold standard is, and this is the whole ethos of monetary metals, and the whole point is you have to go out there and earn the trust of each depositor one at a time by being worthy of that trust, and gather the gold that backs your currency by accepting the gold deposits. And you do that by paying interest, which of course Russia and China and Brazil and India are not interested in doing, no pun intended. They're not going in that direction at all. At this point in the world in 2023, it's going to have to be a bottom-up entrepreneurial solution rather than a top-down dictatorial approach. So don't trade gold based on these. These are propaganda being promoted by people that are either selling gold or some other thesis of whatever it is they're trying to do. There's one other thing I'd like to touch on. Do I have another minute? Yeah. Is the idea that Biden, I mentioned most of our clients probably, Biden is a traitor and trying to undermine and destroy the American currency. And that's what's, driving all of this. Aside from that, rumors of the dollar's demise have been appearing every few years in Time and Newsweek, going back to at least 1970, if not earlier. The two parties are like a cat and a dog, in a car that's driving way too fast and there's no people in it. And they're fighting to take over the steering wheel. And each one of them is blaming the other if the car's swerving this and that. But neither of them really have a great deal of control, because at 250 miles an hour, the car basically just wants to go straight by inertia, and the dollar is on the path that it's going. That's the first point I want to make. The second is that this idea of the world's reserve currency, everybody assumes is good for America. It's certainly bad for the rest of the world. And so if you accept zero-sum thinking, if it's bad for them, it must be good for us, right? The architect of this insane system, so I shouldn't say after, near the end of World War II, it was all over in Europe, it was about to be over in Asia. The US sat down and dictated at Bretton Woods a treaty to the rest of the world known as the Bretton Woods monetary system, which effectively we're on the vestiges of now. And that said to the rest of the world, this is how it's going to be, because the US was the only power left standing. The rest of the world's infrastructure, lie in ruins, and their productive capacity was destroyed. So the US said, this is how it's going to be. and dictated the terms of it, which is you're all going to use the US dollar as if it were gold, as your base or reserve asset, which still persists to this day. And the US dollar is going to be redeemable in gold should you need it, which does not persist after Nixon defaulted on that in 1971. What people don't realize is this system that's supposedly good for the United States was the creation of a man named Harry Dexter White. You can Google this guy. Harry Dexter White was an apparatchik in the Roosevelt administration, who was later proven to be a tool working for the Soviet Union. His goal was to undermine and destroy America. And he proposed a system that today every patriot wants to defend and say, we want to be the world's reserve currency, and the loss of it is traitorous and so on, when in fact the design of this was designed to undermine America. It is succeeding at undermining America, just taking much, much longer than Harry Dexter White had any of the foggiest idea in 1944. Here we are almost a century later, and it hasn't finished America off yet for a lot of reasons. But that's what it was designed to do. It would actually be good for America not to be the issuer of the world's reserve currency. But unfortunately or fortunately, we're not losing reserve currency anytime soon. There simply is no other currency that comes remotely close to being able to replace the dollar. Certainly not any of the dollar derivatives, such as euro, pound, yuan, yen. We won't even talk about Brazilian real, which is nothing more than a Latin American banana republic, toilet paper currency, let alone India and the rupiah. India has been a basket case since before America was founded. It's going to continue to be a basket case. For anybody who disputes that, I would say go visit, and you'll see just how baskety that basket case is. Nobody is looking to India to issue anything, and certainly not a reserve currency of any kind. There's only one thing that can replace the dollar as reserve anything, and that's a four-letter word that describes a heavy, shiny metal, which ain't nobody want that, so that ain't gonna happen. Am I out of time?
Yes.
And with that, I will leave it there.
Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.